Good afternoon, all of you. Renisha from Commodities Research. Today, I am here to present my views on commodity for this week. Commodity markets continue to be affected by macroeconomic developments rather than demand supply in the previous week. Sell-off in bond markets resulted in the rise in yields and in turn triggered liquidation in commodities with gold as particular. Earlier in the week, market sentiment was buoyed as China did not announce a rate hike even though the inflation exceeded 5% in November. The risk on environment continued as FOMC meeting was a quiet one. Extension of tax cuts and beginning of US economic data, except for the employment report, boosted confidence in the country's recovery, triggering upgrades in the consensus forecast and speculation that Fed will not need to extend monetary easing after QE2. Bullishness diminished later in the week as the debt problems in the European periphery showed signs of contagion. Moody's warned that it may downgrade credit rating of Spain and Greece, followed by a 5-notch reduction in the Ireland rating. The EU summit in Brussels ended with the financial leaders agreeing to amend the treaty to create a permanent debt crisis mechanism in 2013. The boost to the euro and growth assets will be limited as the meeting lack measures to solve the problems in the near term. Crude oil prices remain in consolidation mode, trading above 85 and below 90 for the entire week. While prices were boosted as the crude oil inventory plummeted during the week, gains were limited amid the sovereign concerns in the eurozone. Gas prices tumbled last week amid the warmer than expected weather forecast. Gold fell below $1,400 and finished the week around $1,380 as US dollar strengthened and treasury yields soared. While the passage of US tax bill and the failure of EU to come up with the new measures to stem contagion of sovereign crisis did not have much impact in the metal in the near term, they should be gold bullish in the long term. In fact, talking about the base metals, although sovereign crisis dampened the market sentiment and LME stocks rose modestly, the complex remained resilient with the LME metal index rising 1.3%. Despite a brief retreat below $9,000, LME copper rebounded and settled at $9070. In 2011, the complex should continue to perform as well as the advanced economies will stay accommodative in implementing monetary policies, while emerging markets are expected to grow robustly. For this week, gold has a strong support at rupees 20,370 and resistance at 20,650 at MCX, while silver has a support at rupees 43,800 and resistance at 44,800 at MCX. One should buy above this resistance levels or sell below this support levels. Talking about the crude, it is expected to trade firm and it is looking strong, and the decisive break of $90.75 at COMEX will target 9% upside to $98 as far as the $87 support holds. Natural gas looks bearish with the support of 180 and 176 at MCX, and the view will turn positive only if it trades above rupees 192 in the near term. Base metals would also trade in a positive territory, and the view is buying on dips, with copper and nickel looking the strongest among the metal spec, and they have the target of 430 and 1150 at MCX respectively. We may see some unwinding of the positions in metals as CME COMEX has raised margin in silver by 6.9% and in copper by 18.75%. So one should trade cautiously in metals in this week. This is all from my side. Please read to our Commodity Weekly report for more details. And bye. Happy trading.